transforming a technique into a strategy, developing a true trading edge, managing your risk appropriately. Time can be an important parameter in your strategy, and how martial arts had an influence on this trader's career in trading. All this today and more on the Futures Radio Show podcast with President of Gramza Capital Management, Dan Gramza. Futures Radio Show is sponsored by CME Group. They are the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com. For new show notifications, please subscribe to Futures Radio Show podcast on iTunes, YouTube, Google Podcasts, Spotify, or Stitcher. This show is also sponsored by Trading Technologies, RJO Futures, and FTSE Russell. The Russell 2000 is a key benchmark for small-cap U.S. stocks. Be sure to check out the E-mini Russell 2000 futures symbol, RTY, and Micro E-mini Russell 2000 futures symbol, M2K. To learn more about FTSE Russell and their products, please visit FTSERussell.com. Big fan of yours, been following your stuff for many years, and I actually am not even sure. I think that we met in person at one point in time. It was years ago. Remember when we used to go to conferences?
Yes. yes.
And
that's true.
And, you know, I've watched your videos over the years. You do a great job at educating people on futures markets. And although I know a lot about really your style a little bit, because I've watched a lot of your videos, I don't know a ton about your background. So I wanted to just start there today. How did Dan Gramza get started in futures markets?
Well, I have to tell you, I guess I would take it one step back further, and that is the financial markets. What attracted me, and this was when I was in college, I was studying to be an engineer. I had a scholarship to pursue that area. I realized I didn't want to be an engineer, but what always fascinated me were the financial markets in general, because I felt it was the most efficient way to use capital. You take capital and you have inventory that's very liquid, and you can easily get in and out of that inventory. It also attracted me because I felt that it would be a simple way to increase a business. You know, you're not building a new warehouse, you're increasing the number of contracts you're going to trade. And at that moment, you just increased your business. So that part attracted me. I felt it was an efficient use of capital, but I didn't come from a family background where anyone had stocks or was involved in the financial markets. So it was my passion to find out more about that. And I actually started with the idea of stock options. The concept of options really attracted me. And I went over to the options exchange, actually to First Stop, to learn something about options. I thought I'd be an option market maker. So I was going through the things that they had available to help me with that. And I thought the delta neutral spreads would be it. I didn't have to worry about price. This is fantastic. But I realized I eliminated price, but I got a new friend, volatility. So I thought I should look at price again. Well, as an option market maker, they really don't care about price. You really care about the Greeks to manage your position. So I thought, okay, I should look at price. You know, you think about it, Anthony, any book you pick up on options, it says if you think price is going up, you think price is going down or going sideways, here are the strategies you can use. Well, it always seemed to me that decision about price was kind of a critical part of that process. The people that would look at charts were those guys across the street at the Board of Trade. And I had an opportunity through a friend that I knew through the martial arts, actually, Bill Helmer, who invited me over I was talking to him about this, and he said, "Why don't you come over here and see what we do?" Uh, it it fascinated me, not because I didn't really want to trade on the floor, but what fascinated me on the futures side were first they did pay attention to price, and there are different charting methods that they used. But what really, for me, put the pieces together was one, Bill just asking me to come over, seeing the pit, watching the broker's hands, because the broker's hands who would stand on the top step, if everybody's hands are, palms are towards them, they're buying. If everybody's hands are, the palms are away from them, they're selling. So that basic idea stimulated me to the next step. And what fascinated me, if I watched their hands and I'd watch a computer screen, it was a CQG in the financial floor. If I watched that, I started to see a connection between the broker's hands and that screen. When I saw that, the pieces came together for me. And then I was teaching a course at Bank of America in Japan, and it was for yield curve traders, customers of the bank, other banks. And a part of it was to go into the dealing room and put on some trades in 30-year treasuries. So I went in the dealing room, it was right next to our classroom, put on some trades. I'm walking out and I see a fellow drawing by hand these candle charts, which I had never seen before. And Kuno-san, the gentleman I was with, he said, "Oh, these are Japanese candle charts." And when they were kind enough to talk to me, what went through my mind is what I just mentioned to you. The idea of a candle, the way I look at it, I call it behavioral candles. They're a picture of what those brokers' hands were doing on the floor. So when I've had the opportunity to do courses with floor traders in the US at a variety of different exchanges or in Singapore, that was the relationship I try to bring to those traders, because if they could see the connection between the floor and a screen, then their ability to make that change, if that point comes in time, would increase, I thought. So anyways, that's a long answer, but my transition to futures was because they did look at price. And that was the primary motivation, actually, that started that whole journey for me.
Man, that journey sounds so similar to mine. I actually started as a runner by accident.
Ah,
When I say by accident, it was actually I got in a car accident. I took a job that I saw in the paper as a runner to strengthen my
ah,
leg. Long story short, I got into the options markets. I was a clerk in there after everybody starts in the meets, and then I got to the options. And then when I went to the S&P
okay.
pit, that's what really changed everything for me. And I said, you know what, options aren't for me. I'm gonna look into futures. And going back to that time where you finally said, you know what, this is where I want to be. What did you
Hmm.
then do next to start developing a strategy? Because you already had, you obviously had some background. You worked in the industry a little bit, and now you're looking to become a trader. Talk to us about that process in developing your style and your strategy.
Okay, I can tell you what I did. I bought a small seat on the Chicago Rice and Cotton Exchange, and that pit was located in the ag room at the Board of Trade. I did it again, not because I wanted to trade rice, but because I wanted to understand what was happening on the floor. When I started making those connections that I mentioned to you, the next thing I did actually is I really started to focus on what was happening. Uh, I would say this. What my focus came to be is I picked one market. One of the things that can happen when someone starts to look at any market from a personal point of view is they can feel overwhelmed. And now you can feel overwhelmed with information in terms of news and what's happening, overwhelmed in terms of the number of markets that you can trade. That can feel overwhelming. So what I did was I picked one market. That one market happened to be the 30-year bonds. I picked that because one, it was the hot market at the time, with a lot of liquidity, but I took it apart. I had an idea that when the opening range was this big, what would you expect for the day? And these were using some market profile principles as well. And I went to the market logic school and I ended up teaching there actually for a while, about 3 years. And during that time, I really again started with the bond market because I felt if I understood the rhythms of that market, then I could transfer that to other markets. So I spent hours and hours just graphing and doing it by hand of if the number came out, what did that number mean to this market? How did it typically react? What was the range that you would see at the end of the next half hour, at the end of the day? Would it give you clues about the next day? So I really took it apart, I felt. And when I felt comfortable with that market, it was easier for me now to look at Japanese yen because I could say, you know, something, the yen doesn't do what the bond does here. The yen does this. But by having the bonds as a benchmark, as a measure for me, it was a lot easier to add other markets because I could see how they were similar and I could see how they're different. So that helped me tremendously. And then I also thought about the idea of changing from a technique to a strategy, that transition, and that was a big deal for me. I don't know if you want to talk about that, Anthony, but
Yeah, I mean, I'm curious what you mean by going from a technique to a strategy. Explain that a little bit more.
okay. Well, here's what I think is key for all of us, is this. If I look at any technical technique, and I'm talking about, well, even fundamentals, if you want to say, when this number comes out, here's what we expect, whatever it is, especially technical ideas, though. If I say, when these two moving averages cross over, I'm going to buy. And when they cross over in this other way, I'm going to sell. That's a technique. To turn it into a strategy, I want to know the parameters around it. So, first, if I do this technique, what does it typically yield? What would be my magnitude objective? How much does it yield when I trade this market, whatever the time period is, 5 minutes, 15 minutes, daily, weekly? The same analysis would apply. So, what can I expect in terms of magnitude objective? What can I expect in terms of risk? How much heat do I take? Do I have an edge? Will I make money with this technique? How patient should I be? How much time should I give this trade? What is it? What is the frequency of this trade? Is it once a day, 2 times a week? And is it stable? Is it robust? Does it work in trending markets up, down, and sideways? Or does it have a particular environment that it does the best in? If I know those answers, it does a few things for me. Now I have a strategy.
Mm.
And now it's a matter of me being consistent with that strategy by knowing those parameters. So, for example, if you and I would pick the magnitude objective, what does this technique yield with this time period on this market? Just knowing that can be incredibly powerful. You know, I if you and I did looked at this technique, and let's say we made 10 points. The first time we did this trade, we made 10 points. So what is our profit expectation? 10 points. But if we actually looked at what this yields, and we need about 30 examples, we find, let's say in this example, that 80% of the yield on this trade was actually 4 to 6 points. Now, the person who just made 10 points the first time, what is their expectation? They're going to say 10 points. But the person who said, I've looked at 30 examples and I find that 4 to 6 points is where 80% of the time it happens. Does that person who made 10 points, do they take 4 to 6 points? No, because they're waiting for 10 points. So they watch the market put 4 to 6 points in their hand. And the issue is, when do I say thank you? So it puts 4 to 6 points in our hands, and then we watch that money dribble through our fingers. And then we say, son of a gun, I should have taken that when it was at 5 points. Well, no, because I was waiting for 10 points. So that aspect of trade expectation, profit expectation, I think is powerful, because it means that I changes my focus on what I might want to consider. Maybe I take half of my profit, do 2 contracts, do half of the profit at 5 points, move my stop up to break even, and maybe we'll get 10 points. Because maybe that only happens, 5% of the time or 2% of the time. In the meantime, it allows me to adjust my strategy, my expectation to what the market's yielding, not what I want. That's the other thing that it can have an impact on. How many times have you and I heard somebody say, if I make $500 a day, if I make $1,000 a day, then that's it. I'm good. Well, is that what the market will yield? Does your technique provide that? Does the market provide that? So what you want, we both know what you want and what the market gives us can be 2 different things. And if they're
Absolutely.
not aligned, right? If
Yeah.
they're not aligned together, then I'm going to be very frustrated because I'm never getting what I think I want from the market. So each one of those has an impact on us. How much risk do I take? Where do I put my stop? How much time do I give this trade before it fails? How much time do I give this trade before I'm overstaying my welcome? If, in my opinion, if you and I look at any technical approach, that we would look at it and go, wow, that's a clean trade. That's a good trade. Chances are that trade's going to start performing within 2 to 5 periods of your signal. No matter what the time period is, 5 minutes, daily, weekly, chances are it's going to kick in within that period of time. So I use that parameter when I evaluate a trading technique. I use that parameter when it comes to trading options. It's a baseline for me.
This is why I think you're one of the best educators in our industry, because you opened my eyes to something that I had never really thought about before until today. And I've been in the futures industry for 25 years and I've talked to a lot of people. But going from a technique to a strategy, I think back to myself. And the whole time I was just trying to develop a strategy. I wasn't even thinking in terms of technique. But I think the way that you explained it today, I actually think it actually simplifies things for a lot of people that are newer coming into our industry. First thing you talked about was you focused on one market. Boy, do I wish new traders did this, because I think that there's just too much access to everything. I mean, because you and I started on the floors, we saw the floors, we saw how everybody was in one pit. Very rarely did we see those traders trade in multiple pits. There was always some people that did that, but that was not a common thing. So I started with one market, and I was hyper-focused on studying the nuance of that market. Just like you were talking about with the 30-year bond. Once you build that foundation, that allows you to expand on that process into other markets, because every market has a different personality. And what I want to talk a little bit more about is, you said, a lot of traders think about trying to make $500 or $1,000 a day, and the market only gives us so much. This is something else that for me, I wish I was really, being around pit traders, I wasn't really taught that trying to make $500 a day or $1,000 a day is really the wrong way to go about it. Some of my trader friends back then and when they were on the floor, they did it, but it was just such a different way, because I actually went to the screen right away. It just never worked for me. I would literally go in and be up or down $500 when I first started, and at the end of every month, even if I was winning 8 out of 10 days, right? 4 out of every 5. At the end of the month, I'm barely making money. And I'm looking at it going, this is unbelievable.
Anthony, that is an excellent point. And it's also very common. There was a fellow who was in the nat gas pit at the NYMEX. I remember this is years ago. You made me think of him. And Tom was his name. I won't say his last name, but Tom was his name. And I'm getting ready to do my class, and Tom's in there. We're just chatting, and Tom was saying, Dan, I've been tracking my trades, and I'm correct 70% of the time. I said, terrific. He says, but my account keeps shrinking.
I'm laughing not because it's funny, because I've been there.
Well, yeah, I think everyone's experienced this.
Yeah.
And what it is this: he didn't have a trading edge. In other words, what he did, let's say he said 70% of the time, right? So 7 times out of 10, he made money. Okay, so let's say 7 times out of 10, I'm just trying to think of some numbers here. Let's say 7 times out of 10, he made 2 points. All right, so that means theoretically he made 14 points, right, in 10 trades. He only lost money on 3 trades. But let's say that he lost 5 points on those 3 trades. So he made 14 points, 7 times 2, and he lost 15 points. He lost 3 trades at 5 points each. So he lost 15, he made 14. He doesn't have an edge. And the result is his account over time will continue to shrink. He will never make money. But he's going to feel good. He's mentally confident. He's ready to do that trade because 70% of the time he gets positive feedback. So it's that balance. And that's why it's a part of making a trading strategy. Can you make money with the trading strategy? And it's that blend between risk and reward that really we're talking about here. And I'll tell you what happened in his case. I asked him to go back and review his trades in terms of how much heat he would have to take on the trade. In other words, when did a trade fail? So he went back and he looked at when trades worked, and he looked at when trades failed, how much risk did he take? And what he found was his risk really was about 3 points. And when he changed his risk parameter, how much risk he was going to take at 3 points, he became profitable. He didn't change his strategy. He didn't change his market, still trading nat gas. But what he changed was that risk parameter. He was taking 5 points because it seemed like a reasonable number. I don't remember exactly the numbers, but it's something like that. So, right, so he 5 points based upon the way he looked at the market and things seemed reasonable. But the thing that's fascinating to me, it goes back to consistency. So I'm looking at a strategy now I'm working on that is based on this concept, and it's this. If you and I could find a strategy that gives us consistently let's say 3 points, and we're risking 1 point, and maybe that's profitable 70% of the time. And some people would say, geez, you're only taking 3 points, really the market moved 50 points. Is that appropriate? Well, it goes back to how you want to perceive this. If you can take, let's say, 3 points 90% of the time, or you can take 40 points 5% of the time, which would you prefer? So what we could say, and this is what fascinates me about this business, is that if you and I could say we're going to take 3 points 90% of the time, then all we got to do is go from one contract to 10 contracts, 20 contracts, whatever our account and the market can support. And we've just, that 3 points can become 30 points, can become 90 points, can be, just by changing the number of contracts and being patient with that growth. So it's an interesting area when it comes to developing a strategy.
Oh, absolutely. I think that we've talked about them so far today. You find the market that resonates with you. I think that's extremely important. As there's certain markets I just can't trade because I just don't resonate with them. Like the NASDAQ is not for me, but that's a different conversation on a different day. But so then you find the market, then you go and you start figuring out a technique. And I want to talk about a defining moment for me, thinking back now to when I was actually developing a technique when I thought I was developing a strategy, and it didn't become a strategy until later, is moments. We talked about the $500 a day, even if you were right 7 out of 10 times, and so on and so forth. We don't believe that's a winning edge in a strategy. So what I started to do was look at moments. I started to realize that everything works sometimes, nothing works all the time. And I realized that the times that things were working and everything was going my way, to take advantage of those moments. So I stopped putting a ceiling on my upside, and I just only controlled my downside when things weren't going well. So when I look at my career as a trader, how I've made a majority of my money is in shorter periods of time and for moments where maybe things work for multiple days in a row, weeks in a row, maybe even months in a row. Good months in a row is always a great thing for someone like me because I look at this year just to talk about this year. February, March, April, super busy for me. And then all of a sudden it slowly tapered off and I've had to reduce my expectations because markets changed. As long as I keep my downside in check, I'm okay. But those times this year, I've taken more advantage of them. I'm curious what you think about that. Do you put a cap on the upside? Do you not? Do you just put a cap on the downside? What do you think about me, trading and taking advantage of moments?
Well, I have to tell you, that goes back to this concept of consistency, I think. And what you're saying, as long as you and I have that profit expectation in line with what the market can give us consistently, I don't see any problem with it. Now, other people would argue that you want to let your trade mature. You want, if it can garner 50 points, excuse me, by giving it more time, you're better off doing that than just taking 3 points. The issue there depends on the risk. Now, and you already said that, Anthony. You said, if I keep my risk in control, that's huge. That is huge because that's what allows us to survive to the next trading session. That risk management is such a key element here, and you identified that. You identified managing your risk as a part of your strategy, and a lot of times people get emotionally caught in that, where they let their trade expectation exceed the risk parameter that they had. So they go back to give it a little bit more time. It'll be okay. No, I really believe this is going up. Well, what you and I know, and probably everybody listening, is that the market doesn't care what we want. The market gives us opportunity, and our job is to try to identify that opportunity. So whether we take a small amount consistently, the issue here is that we don't want to take a small amount and risk a large amount. That reminds me of a guy, Bob. This guy traded in the bean pit. And Bob and I were talking. He wanted to leave the floor because his knees were killing him. And this is, at the board of trade. I'm setting, getting ready, and Bob comes in, and we're just chatting. And Bob says, "I got a serious problem." And I said, Bob, what's your problem? And he said, I want to get off the floor. I said, yeah. He said, well, I I had a series of losing trades, and I understand that. And he said, and I just wanted positive feedback. So if I had put a trade on and got a little bit of profit, I take it immediately.
Yep, he's got tight.
And yep, and I understand that too. I think everyone's experienced that. I said, sure, I understand. He said, here's my problem. I can't stop doing it. And that is a problem. Because if he's making one tick, but risking 7 ticks, then a series of losing trades, he can dig a hole that'll take a lot of profitable trades to even try to come back. And statistically, he could dig a hole that he can't come back from. He knows that. And the way he did it was he was in the pit. Eddie was his clerk. He would bring in a chart. He would look at it, tell Eddie what to do. Eddie would go outside the pit. He didn't do it in beans. He did it in other markets. But anyways, Eddie would go outside the pit, execute the trade for him. So here's what I asked him to do. And this goes back to the idea of patience. How long do you and I let a trade work? Which I think is a huge parameter. But anyways, so I say, here's what I'd like you to do. Bob, look at trades that you would say that's a clean trade. That's a good trade. Whatever the technique is you're using, whatever the time period you're using, whatever the market, you pick this market, you pick this time frame, and you say, that was a good trade. Look at how long that trade lasts. Excuse me. So from beginning to end, how long did that typical good trade last? So anyways, about 3 weeks later, I see him and he says 45 minutes. 45 minutes to an hour is what his good trade would last. So I said, okay, how about this? How about you wait until you see a trade that meets all of your parameters, that's so clean, it's screaming at you, please buy me. So one, you got to be patient. Wait for that moment. Let the trade come to you. So now you see this trade. Put the trade on. Tell Eddie not to come, put in your magnitude objective, put in your risk parameter, and then tell Eddie not to come back into the pit for 45 minutes. Because what do you and I know? You and I know that at the end of 45 minutes, you're going to have a result. It could be profitable. It could not be profitable. You will have a result. So the issue for him, it wasn't his strategy. It wasn't the market. It was, or change in volatility. In his case, it was him. He wasn't allowing the trade to mature. But if you and I know that at the end of 45 minutes, that's a typical trade, well, then that increases our patience level. It also tells us that if we've been in the trade for an hour and a half and it hasn't worked, chances are it won't. And I'm in a hope trade right now. So that time parameter, that relationship between how much time do we give a trade to work and also do it comfortably? It can be an important parameter. And for Bob, that was a big one for him.
Traders, we're going to pause for 30 seconds and we'll be right back. A question I constantly get is, what platform do I use to trade futures? Well, I use TT. They are the world's fastest commercially available futures trading platform. Learn more at tryttnow.com. RJO is a long-standing brokerage firm with personal broker relationships to help you learn and trade futures. To learn more, please visit rjofutures.com. You know, years ago, a friend of mine got me onto this, and I went to his desk where he was trading, and I saw that he had up a timer. And I go, what are you doing with a timer up there? You know, it was actually not really big, but it was right in the middle of his screen, right in the middle of his charts. He's like, oh, every time I click in, I click my timer. And I was like, why? He's a great trader. He's been on the show. For those of you listening, his name is Brad Jelnick. He's been on a bunch of times. And I was like, okay, you put a timer up there. Wow. And just talking about what you had just said and the time parameter, I started doing that. I don't trade without it now when I'm doing my intraday stuff, because there is a amount of time. He wants to see how long it's taking for things to evolve after he gets in, you know, and we had a whole long conversation about it, but everything that you talked about with that, it is an important parameter that I don't think a lot of people really talk too much about. And I think that for those of you out there, I look at it and go, I'm always testing myself. I'm always trying to get better. Put a timer up and just when you click in and click out of your trades and start jotting down some of those times, it's actually pretty interesting. But I want to move on with you, Dan, because I have a couple other questions I want to get to before we get into our rapid fire today. And I want to talk about position sizing. And
Sure.
We're talking a lot today about technique to strategy. I just love that. I'm going to talk more about this, building a technique into a strategy. Going back to myself, because that's really the only thing I can talk about is myself when it comes to how I went through this process. And another thing that came to me, I guess, from building a technique to a strategy was position sizing. I went through a spell where I just traded the same contract size every single time. And, you know, I was a 1-lot trader or a 2-lot trader or a 3-lot trader, and I tried to grow in that. Then I kind of threw that all out the window, and this was another eye-opener for me. I said, okay, first of all, I need to have 3 sizes. So this is at the beginning, you know, 1-lot, 2-lot, 3-lot trade, a big, small, or not at all. I need to be able to have a range of execution. I also needed to know that depending on how far I was away from my stop, because not every stop was the same distance for me, that I had to adjust my contract size based upon my risk per trade. So what I started to develop as I was going from that technique to strategy was big, small, not at all. Take advantage of moments. That was just drilling into my head. And I really started to excel when I recognized those moments, adding confirmations closer to the stop. You can trade bigger now. You're not necessarily risking more, but you're trading bigger because you're closer to your stop. And that becomes, I think, the art of it, but you don't really learn that right away. What are your thoughts on, are you scaling in? You know, when you're going into a position, is it always the same size? Is it big, small, not at all like me? Talk to us a little bit about that.
I like what you were doing, by the way, and I like the idea of you recognizing the risk parameter with that size. That's very interesting, actually, and very logical. From my point of view, it's a fixed size. For me, it's on or off. Is this a clean setup? Does it make sense? The process I would look at would be, is this a trade? Is it a clean trade? Execute the trade. Then manage the trade. Manage myself, manage the trade. That's kind of the process that I look at. So I'm either on or off, and the size is fixed. I'll increase size. I'll add to a position if I have it. Again, my technique supports that. And so I think the idea of size, it's the real important part is, what does my account sustain? What's appropriate for the size of my account? You know, am I going to risk? The one thing that fascinates me, and I'm sure, Anthony, you've thought about this too, is what's beautiful about trading is there are no rules. The
Yeah.
rules are whatever you create, right?
Yep.
I knew a fella that, listen to this one. He he did it twice. Once with $250,000 in U.S. Treasuries, 30-year. He lost that money. Did one trade. That was the account. Then he raised $6 million from family and friends because it was going to be the year of the bean. The beans and the teens. It was going to be just a tremendous year, expected a drought, all these conditions because of the cycle and things that he was looking at. He lost all that money. One trade. Well, multiple contracts, but I mean one trade. So as you know, we can do whatever we want to do. And what is the appropriate amount? For most money managers, it's about 1%, maybe 3% of the account size risk per trade is the most common one. Some people use a dollar figure. They want to have $10,000, excuse me, per contract, for example. That's what they're thinking about in terms of their account. How much of their account is devoted to something? So there's a variety of different ways of approaching it. For me, though, I have a fixed amount. Either the trade is set up, it's clean, it meets the criteria, done. So it allows it, by defining these parameters that you're bringing up, it's one more thing that allows us to trade what I call effortlessly. It's really almost mechanical. So is that a trade? Yes. Is it clean? Yes. Done.
Do you consider yourself more systematic in your approach? Discretionary, combo?
A combo. I would say, well, the things I'm working on right now are very mechanical. It's identifying some volatility periods, and it's a mechanical decision in terms of what's going to happen. But in general, I would say I have analysis. I look at, these candles or whatever it is that I'm looking at to make a decision. But the application of now your strategy, that's mechanical. Because as we if that's a trade that you and I can do because it's met everything, then profit objective, risk parameter, how long I'm going to hold the trade, expectation of when this should finish, that's all mechanical. Because you and I have done that before we do the trade. So if I have answers to those questions, now it's just a matter of implementing it. As we both know, the worst time to think about a loss is when we have a loss. Risk management, when we have a loss, it's difficult. It can be stressful. It can be like, oh my God, what am I doing? No, it's getting worse. And that's the worst time to think about it. But if I knew that before I did the trade, then okay, I had a loss. Is that a big deal? No, because it fits within the range parameter for my account. So will I be here tomorrow? Yes. So having a loss isn't really a big deal. It is if it takes half of my account.
Yeah.
Are we going to have losing trades? Yes. That isn't the issue. The issue is how you and I manage that risk and what percentage of our account.
One of my mentors, I believe you know him, Mickey Hoffman, and
Oh, sure.
yeah, Mickey was
terrific guy.
Yeah, he's one of the greatest people I know. And
He
in my career, he mentioned something to me that really helped me develop as a trader, and that was, he's like, Anthony, you're a great healer. And I'm like, what do you mean, Mickey? Because like every time I see you, even though I know you're getting your ass kicked by the market, he's like, you're always upbeat, you're always positive. And I realized that going into every position, because I knew what I was going to risk, I was healing. The healing process began as soon as I got in. So the worst of it was already behind me, because at that moment I've already committed to it. So now it's just a matter of, okay, you're trading, and that, when he pointed that out to me, really just helped me with just my own awareness, self-awareness, and just the importance of knowing your risk going into the trade so you could begin healing right away. And I think that's a lot of what you're talking about today. And I want to go into my last question before we get into rapid fire, because
Sure.
This is one of the things I've been waiting to talk to you about. It's like, you're one of the nicest guys I've ever met, and you're one of the last guys I'd ever mess with, because I know you have black belts and all these different things, and it's like, okay, I want to know how much martial arts have had an influence on your career in trading.
Well, I would say this. I have been blessed with having fantastic instructors in a variety of different martial arts. And you can teach, for example, karate as a sport, you can teach it as an art. And I was blessed with instructors that taught the art. And I've had a chance to share that with other people. I think what it does, no matter what the martial art is, by the way, there's a common goal. And the goal isn't self defense. I've never used my martial arts actually, but the objective is for you to learn something about yourself. It's your self discovery. And the martial art, whether it's punching or kicking or throwing or whatever you're doing, or the weapon that you're working with, it's just the tool that leads you down that path. So I think that helped me tremendously. It helped me be patient, waiting for that trade to develop, for example. It helped me in terms of how you react to a market. I've had the chance to work with institutions around the globe, and I remember being in a bond dealing room in London, and this fellow, uh, he slammed his phone down so hard he broke the handset. That's hard. It's hard to do that. But there's an old saying: an angry man defeats himself. And that's what was happening. Did he see other opportunities that could have been better than what he just got out of? No, because he's lost in this anger at that moment. And it's just not productive. It's like what you said. And I think that was so important about you healing. Were you surprised to have a loss? No. It's a business decision, it has an outcome. Now you go to the next trade. So um, I just think those pieces are important. And for me, martial arts helped in that regard. It helped me stay focused, I guess, on what I was trying to accomplish. And so I think it was a good guideline for me. And plus, it also offsets what you're dealing with on a daily basis when it comes to the markets, whether it was a productive day or not a productive day.
Creates balance.
Creates balance. There you go.
Yeah, I mean, early on in my career, I was the person who would get very frustrated, even though Mickey would always say I was in a good mood. I had a lot of internal frustration, and sometimes I would, go and lift weights and just do other things and just like push myself really hard to kind of like burn off that frustration. And all that did was kind of feed it more because I wasn't offsetting it. I wasn't creating balance. In the middle of my career, when I began to meditate, I felt so much more in control of my decision making during the day. It just creating that balance to when I'm at my screens, I actually could sit there and be more present, be more focused on what was happening instead of having this kind of fiery attitude, which is where I was prior to that.
That is an excellent point, Anthony. Excellent point. You're right. That does make a big difference. It allows you to stay in the present moment. There's two things that I think are important. Staying for us, not only just in trading, but in life in general, is staying in the present moment. And I when you said that, you made me think about two groups. One were the Spartan warriors in Greece, and the other one were the Japanese samurai warriors. Different parts of the world, different points in time, but they had two common beliefs that I think are so powerful. The first belief is they focused on eliminating the fear of death. Now, if you're a warrior and you're going into battle and you're afraid to get hurt, you're dead.
Yep.
If you're a warrior going into battle, and this could be it. If you went in with that attitude, imagine what it does to your brain, how freeing that moment is. Are you going to hold back when you swing that sword? No. And you hear these unbelievable things that would occur with these two different groups in battle, but they allowed that to happen. It was freeing, just like you said, when you understood the risk, when you had a chance to relax, which is that meditation. It's freeing. It allows you to be free to just take advantage of the moment. And that was the second thing that they did. They focused on stretching the present moment. For example, if I'm going into battle and I think about yesterday, I had a really good day yesterday, it's irrelevant to this moment. Or tomorrow, I got to get through this moment to get to tomorrow. So they realize the only moment of time that we ever have impact is the present moment. And we experience it in little ways all the time. If you think about a food that you love, that you make, your family makes, or you go to a restaurant, they just do it like nobody else can. When at that moment, when you see it, all your senses come into play. You smell it, you taste it. It's fantastic. Your mouth is watering. Those first few bites are unbelievable. It's everything you thought it would be. That is the present moment. You're really experiencing that taste. I mean, typically we eat mechanically. We don't eat in the present moment. So it's that mindfulness idea. And these Japanese samurai warriors spent a lot of time trying to be aware of the present moment, because in battle, that's where you live. And when you and I trade, we're in the present moment at that moment, whether it's a trade for 5 minutes or a trade that's going to last for 5 months.
Man,
So you bring up a good point.
yeah, Dan, all I could say is that I could keep talking to you all day about all these different things. You got me thinking about how I eat now and everything. but but we got to keep the conversation going for this podcast. So up next is rapid fire questions. If you're ready for those.
Okay, sure. Fire away.
All right, everybody. Our rapid fire segment is sponsored by Trading Technologies. Trade the global markets with TT. They are the world's fastest commercially available futures trading platform. Now with integrated tools for advanced options trading, cryptocurrencies, and trade surveillance. Learn more at tryttnow.com. Dan, first question for you. What trader has influenced your life the most and why?
I would say Bill Helmer. Bill is the one that really introduced me to futures. And futures gave me a chance to see the relationship between price and the action in a pit. And that was truly a changing moment, life-changing moment for me when I started seeing that relationship, that it didn't have to be on the floor to see that chart that revealed the action that was happening on the floor. So I'd say Bill really started that journey for me.
What was one of the hardest things you had to overcome in trading?
I'd say trading price, not your opinion. And here's, I can give you a quick example. It's 1993, Mississippi and the Illinois River overflowing their riverbanks due to a snow melt from Minnesota. And I happen to be long beans. Beans were really taking off, and this is before the July 4th weekend. Anyways, after I went down to the Cahokia Indian Mounds, which is near St. Louis, with my wife on the July 4th weekend just to go see him. Anyways, I'm driving through all this farmland. I see flooded corn, beans. It's a disaster. So I came back at the end of the weekend, beans went up limit. And then they kept moving up higher. And then it had what I call market getting ahead of itself, a candle technique I look at. Anyways, took off half the position. It rallied up again, did it again, took off half the position. Now I have no position. But I was trading Not at that point, but now further on, my opinion. My opinion was that beans are going back up. I saw how bad it looked when I went down to St. Louis, that area. So what I was trading now was my opinion. Beans started going down. Did I sell beans? No. Did it, when it started to move up a little bit, did I buy beans? Absolutely. Did it work? Maybe a penny, maybe. And then it'd start moving back down again. It'd start to move up a little bit, I'd buy it again. I didn't recognize that was profit taking. I didn't recognize the market was right. I didn't recognize that price puts money in my pocket and price takes money out of my pocket. My opinion is just that. It's an opinion. Market doesn't care what my opinion was. And in fact, the rest of that year, bean prices went down. Did I ever sell it? No. And at the end, the market was right. Was it terrible where I saw it? Yes. But we only lost about 10% of our crop. Other areas had fantastic yields. So it wasn't disastrous. It wasn't my perception of what I thought it was. And it taught me a lot. It taught me to recognize profit taking. It taught me to recognize price action, to lean on that, not my opinion. So that was a big one for me.
How has your trading process evolved over the years?
I'd say it's become very methodical, very mechanical. Because of those parameters that you and I talked about, to transition from a technique to a strategy. If I have a strategy of profit, risk, all those things that we talked about, I just have to implement it. That's all. And that is mechanical.
What is one attribute that you believe every trader should have?
I think patience. Patience, patience identifying the market you want to trade, so you don't feel overwhelmed. Patient in terms of identifying a technique you want to use. Patience in terms of taking that technique, turning it into a strategy. Patience waiting for that trade to come to you so that it meets your criteria, that you're not trying to jump ahead of it. You let it develop. And when you're in it, you let it mature. I think patience in terms of applying that consistently. So I think patience is an important parameter for us to have when it comes to trading.
Favorite book about trading?
I would say Markets 101 by Kevin Koy. It's on Market Profile.
If you could pick one profession other than trading, what would it be?
Um, I would say teaching. I've been blessed. I was fortunate in the martial arts to again learn from wonderful instructors, and I really enjoyed sharing those ideas. I enjoy in the trading side. I've been blessed by the markets, and I enjoy sharing ideas with other people. Maybe they don't have to go through the process I went through to reach some of those conclusions. And we both know if you can help somebody, you can't beat that feeling. I mean, it's kind of what life's all about in a way.
What's the best piece of advice that you received about trading?
It's from a tall fellow, had gray hair, combed it back. He was on the ag floor at the Board of Trade, and his name was Everett. And I feel so bad. I can't remember his last name, but I'm sure anybody who was down there knows who I'm talking about. Super nice guy. But what he said to me was, if you want to survive, you have to learn to love to take a loss. And I must tell you, when he said that to me, it didn't register. I'm thinking, love to take a loss. I'm trying to make a profit here. I didn't understand it, but it's so much wisdom in that. He was so right. And it goes back to Anthony, what you said earlier. when you recognized managing risk was so important. And if we know that we're going to have a losing trade, that isn't a big deal. It's just how big is that losing trade? And is it appropriate for the technique? Is it appropriate for my account? If it is, okay, I have a loss. So learning to love to take a loss, I think, is an important parameter.
If you could give the younger you a piece of advice after everything you've learned about trading in the markets, what would it be?
I think don't marry an opinion or a position like I was mentioning earlier. What we do is that we're running a business. I think it's important to think of it this way. And we're business managers, and we manage information flows that come to us like anybody in any business. If I have a restaurant, I got to manage information flows about how much to order, what to charge, all that kind of stuff. Same thing when it comes to the markets. We're information managers, we're business managers, and we're going to make a decision, a business decision, when we put that trade on based upon the information we have at that point in time, and it fits our strategy. That is our business decision, and it will have an outcome. It will be positive, it will be negative. I don't say right or wrong because it implies a personal connection to the market, and there is no personal connection. It's only what I create mentally. So the issue is, have I identified my magnitude objective, my risk parameter trading edge, and the frequency and the robustness of this trading strategy? If I have, it will have an outcome, and the outcome will be positive or negative. And I'm good with either one. If it's negative, then I say to myself, did you follow your trading strategy? And if I did, I pat myself on the back and say, good job, Dan. So I think that becomes a critical force.
If you had an elevator pitch me your edge in trading, what would you say?
I would say it's the evaluation and that transformation from a trading technique to a trading strategy. And it goes back to those parameters: magnitude objective, risk parameters, trading edge, frequency of trade, robustness of your trading strategy, getting those answers before we ever put the trade on.
Last question for today, Dan. What's your favorite
Okay.
thing to do when you're not working?
Actually, spending time with my wife, going for walks. It used to be going to restaurants, but we haven't been doing that lately. Martial arts, I still enjoy doing some of my techniques. I don't have a school anymore, so I don't teach the martial arts, but I do have a chance to do some of the techniques on my own. I like working out, like going to the health club. And although I haven't been doing that lately because of the virus thing, although my club did open, and I also attempt golf once in a while. Um,
I do too.
I enjoy it. It's a social thing for me. I'm not that great. If I miss a putt, I miss a putt. It's more being out with friends and enjoying the birds and the animals on the course and visiting.
Dan, you're not on social media, but where can people go to learn more about you? Maybe a website.
Um, well, I guess the easiest would be just dangramza.com. And there's a free video that I do it daily, and it looks at 22 different markets. I pick something from each one of those markets. It lasts 2 to 3 minutes, depending on what's happening that day. And the idea behind it is, if someone's thinking about trading futures, one of the places you might want to begin is just watch them, look at them. And in this case, you're just hearing how I'm thinking about these markets. And you'll see red and green lines, which represent bullish and bearish levels or buy and sell levels. From my point of view, these are not trade recommendations. I don't know who's watching. I don't know what's appropriate for them. But the idea is just to see how someone's analyzing these markets. And if you only trade stock indices, maybe you want to look at some other markets. Maybe crude oil is of interest to you. Now you can see how someone's approaching those markets and how do they relate to each other. I look at 6 different sectors: stock indexes, currencies, interest rates, metals, energy, and ags. The reason I do is it one of the beautiful things about futures is it allows us to see how capital flows between these different sectors. So when the stock market's going up, where does that money come from? And if we see interest rates going down, that would be a typical place that we would see that kind of relationship. So I guess that would probably be a spot.
I highly recommend everybody goes and checks out your site. Dan, all I could say is that, I'm so glad that we finally got a chance to talk on the podcast. I've been following you for years. Thank you so much for sharing your backstory and your wisdom today with us, transforming a technique into a strategy, and just everything today was just so much fun. I can't thank you enough. It was such an honor to have you on the show today, Dan. Thank you so much for joining me on Futures Radio Show.
Anthony, thank you. Very kind of you. I appreciate your kind thoughts, and I hope the listeners have a chance to extract something out of our conversation that maybe helps them. Thank you so much for giving me the opportunity to visit with you. I've really enjoyed it.
Thank you for listening to Futures Radio Show. If you enjoyed the show, please leave a review on iTunes. You can listen to all of our episodes on futuresradioshow.com, iTunes, YouTube, Google Podcasts, Spotify, and Stitcher.